If Costco raised prices by just 5% tomorrow, profits would jump by more than 50% overnight. Yet, year after year, they refuse, risking everything to keep a $1.50 hot dog and a $4.99 chicken unchanged, even as competitors quietly adjust. The real reason is not about math. It is about a bargain that once broken can never be repaired. How does this invisible contract shape what you pay, and what happens when even a tiny price shift snaps years of trust? A single price tag, unchanged for decades, tells you more about Costco than any annual report. The hot dog and soda combo, $1.50 since 1985, has become a legend, not just for its value, but for what it represents. Former CEO Jim Sinegal once told his successor, Craig Jelinek, that raising the price was out of the question. When costs climbed, the answer was not a price hike. Instead, Costco built its own hot dog factories, cutting out suppliers to protect that $1.50 promise. The same discipline holds for the rotisserie chicken. While feed, labor, and transportation costs rose, Costco refused to budge from $4.99. To keep it there, the company backed a $450 million poultry complex in Nebraska, an entire supply chain constructed for a single item. These are not loss leaders in the traditional sense. They are public commitments, visible proof that restraint is not just a slogan. Every time a member passes the food court or grabs a chicken for dinner, the message is clear: the bargain is still in place. These anchors are expensive to defend, but they are the foundation of the trust Costco sells. Without them, the whole system starts to wobble. Sarah's routine at Costco reveals something subtle but powerful. Over 8 years, she has stopped checking flyers, abandoned price tracking apps, and no longer bothers with unit price math. The reason is not just convenience, it is trust, built by those unchanging price anchors. Behavioral economists call this a cognitive shortcut. When prices hold steady, the mind goes on autopilot. Shoppers like Sarah no longer feel the need to compare because they believe Costco's promise. No games, no surprises, no taking advantage. This shortcut saves mental effort, turning shopping into a habit rather than a hunt. That trust, though, can mask reality. On any given week, a staple like cucumbers might cost $7 in a Costco multi-pack, while Sam's Club sells a similar pack for $3. The difference often goes unnoticed because members are not looking for it. They have been trained to expect fairness, not to chase every last deal. The psychological contract at play is not about being the lowest price everywhere. It is about restraint, predictability, and the comfort of not needing to second guess. Once that trust is in place, the act of shopping becomes less about calculation and more about confidence, but the entire shortcut depends on the promise holding firm. If it slips, the habit of not checking can vanish overnight. The 2024 membership fee increase landed with a thud. For the first time since 2017, the Gold Star membership rose from $60 to $65. Executive members now pay $130, up from $120. On paper, it is a small change, barely the cost of a single Costco lunch, but for members like Sarah, it did not feel small at all. She renewed, but something shifted. Over coffee with friends, she admitted, "I am afraid to go to Costco." The fear was not about $5, it was about what the increase represented. For years, the unwritten agreement had been clear. Costco would hold the line, even when everyone else gave in to inflation. Now, that contract felt shaky. Behavioral economists call this loss aversion. The pain of a price hike stings 2 times as much as the pleasure of a discount. At Costco, the effect is amplified. Members do not just pay for access, they pay for the comfort of knowing they will not be nickel and dimed. When a fee goes up, it is not just a new number on a receipt. It is a signal that the restraint they counted on might be slipping. That is why a $5 increase can feel like a breach, not a business decision. Sarah's Costco habit used to run like clockwork. Every Saturday she would fill her cart, rarely spending less than $150. The membership fee felt like a sunk cost, already justified by the rhythm of weekly trips. But after the fee increase, her pattern began to slip. In week 1, she shopped as usual. $150 at checkout, a cart loaded with essentials, and a few impulse finds. By week 3, hesitation crept in. She skipped the bakery aisle, left out a new kitchen gadget, and her total dropped to $80. The routine started to break down. In week 4, she did not go at all. Instead, she tried Walmart just to compare. What began as a minor change in behavior became a new pattern: fewer visits, smaller baskets, and a growing sense of caution. Over a year, that shift is dramatic. A weekly shopper spending $150 per trip spends $7,800 a year. If visits slip to once every 2 weeks and baskets shrink, annual spend can fall below $2,600. The difference is not just in the numbers. It is in the loss of browsing, of unplanned purchases, of the very habits that made the membership feel indispensable. Costco's membership renewal rate stands at 92.8%, a number that looks unshakable on paper. For management, it's a comforting figure, proof that members like Sarah are staying put. But that number hides a dangerous blind spot. Renewal is not a once-a-year decision. It is a slow accumulation built from every trip, every deal found, every time a member leaves the store feeling justified in paying the fee. Each visit acts as a micro-confirmation, a quiet checkmark in the mental ledger. I use this place. I get my money's worth. Sarah's habit of shopping every Saturday did not just keep her pantry stocked, it kept her membership alive, one small affirmation at a time. Even when her routine started to slip, the impact was not visible right away. The renewal rate, after all, is a lagging indicator. By the time members start to question whether the fee is still worth it, the behavioral cracks have already formed. The real danger is not in a sudden wave of cancellations. It is in the gradual erosion of habit, masked by a statistic that only tells the story after the damage is done. For a model built on trust and repetition, that lag can be fatal. Costco's entire model depends on a delicate balance. The moment visit frequency drops, the chain reaction begins. Lower traffic means less buying power with suppliers, which weakens Costco's ability to demand the best prices. As costs rise and volume slips, the pressure to cut value or raise prices grows. But with net margins around 2.9%, there is almost no cushion. Membership fees, $4.8 billion last year, make up more than half of operating income, accounting for 51.6%. Even a small decline in renewals or visits can tip the system from profit to peril, exposing just how fragile the engine really is. In 2012, JCPenney scrapped coupons and sales in favor of straightforward fair and square pricing. Shoppers, conditioned to hunt for deals, felt lost and betrayed. Sales collapsed by more than 20% within months. Even after the company reversed course, the damage stuck, traffic never fully recovered, and the brand spiraled toward bankruptcy. The lesson was not lost on the rest of retail. Amazon, meanwhile, changed habits in the opposite direction. By making price checking effortless, it taught millions to compare before buying, and once that reflex takes hold, it never fades. Trust, once broken, cannot be reset with a simple apology or a rollback. The habit of not checking prices is fragile, and once it is gone for good. Walmart and Sam's Club move prices up and down with rollbacks and promotions, training shoppers to expect change. Target rotates sales and leans on seasonal cycles, not fixed promises. In a recent AARP study comparing club baskets, Sam's Club came out cheaper than Costco by nearly 18%. For these retailers, price movement is normal. Customers accept it and keep shopping. Costco, by contrast, has made restraint its entire brand. Today, Costco's 2.9% profit margin is a razor's edge, not a cushion. In a world of rising prices and shrinking trust, restraint is its only defense. The true risk is not higher costs, but breaking a habit that took decades to build and that can unravel in months. What would make you reconsider?